Hello and welcome. You're tuned into CNBC TV18 Prime. Let's get cracking on a brand new episode of The Big C. I'm Manisha Gupta, back with your daily dose of commodities, cryptos and currencies. Well, a quick look at the global markets first, and the moves follow a winning day on Wall Street with the S&P 500 and Nasdaq reaching new intraday and closing record highs on Wednesday for the second straight day in a row. Both indexes actually have finished the session with a gain of 0.3% and 0.1% respectively. The Dow Jones Industrial Average also rose by nearly a percentage point on the day. Meanwhile, stocks in the Asia Pacific are tilting towards the red as investors bet on a rate cut by the U.S. Federal Reserve next month. In the month of September, 25 basis points as of now completely factored in. Shifting focus then to the crude oil prices ahead of that most crucial meeting between the U.S. President Trump and Russian President Putin. Tomorrow, prices have seen a decline to the lowest in 2 months. Crude inventories in the United States have also risen by 3 million barrels. However, prices, as you can see right now, are gaining slight ground on the back of rising risk premium. The U.S. President Donald Trump spoke to European leaders ahead of the meeting with Russian President Vladimir Putin. Tomorrow, CNBC's Eamon Lajauer brings us a report on what is at stake in the meeting.
We're told that call between the president and European leaders took place at 9 a.m. this morning. President Zelensky of Ukraine in Berlin today, meeting with European leaders, trying to set some parameters around what he may or may not agree to ahead of this high-stakes meeting between Trump and Putin in Alaska on Friday. The president has been monitoring some of the television coverage, and he's seen some criticism today of this meeting, criticism that simply by meeting with Vladimir Putin on U.S. soil, he's granted the Russian president some kind of a win here. The president taking to social media to express frustration with that idea. Here's what he posted a short time ago. He said, "Very unfair media is at work on my meeting with Putin, constantly quoting fired losers and really dumb people like John Bolton, who just said that even though the meeting is on American soil, Putin has already won. What's that all about? We are winning on everything," all caps, says the president of the United States. The question here is, what agreement can these two countries come to on Friday? The White House has said that Vladimir Zelensky of Ukraine will not be at this session in Alaska. So is there a deal that the U.S. can broker with Russia without Zelensky at the table? The White House press secretary Caroline Leavitt saying yesterday that this is more of a listening exercise for President Trump to simply hear out what Vladimir Putin wants and what he might consider in terms of final negotiations. So the expectations here, I think, being tamped down from this White House about whether or not we'll get a final deal here to bring an end to the war in Ukraine, more like a sense of what the Russian position is going into some final negotiations. Whether that war can be brought to a close this year, really, really up in the air at this point, guys. Back over to you.
Oh, well, absolutely. That's an interesting update. Thank you so much for that. But also, when asked about any possible consequences for Russia if President Putin does not agree to stop the war after their meeting, Donald Trump said there will be severe consequences. Let's listen in.
Will Russia face any consequences if Vladimir Putin does not agree to stop the war after your meeting on Friday?
Yes, they will. Yeah.
What will the consequences
There will be consequences.
Sanctions, tariffs?
There will be, I don't have to say, there will be very severe consequences, yes.
All right, so that's a statement really coming in. If the meeting does not go well and if there is no agreement, there could be severe consequences for Russia. Joining us now to take that conversation forward is Mahjabeen Zaman, who's head of Forex research at ANZ Bank. Mahjabeen, hi. First of all, your sense on the statements really, and as the U.S. president put out on Truth Social that there are more people really part of this negotiation than they actually are, with the kind of media reporting one and the kind of preempting of that meeting seems to be happening. What is your sense? How are you getting into this meeting and the kind of impact that we've seen on various currencies?
Great. I think in terms of currencies, two things, right? First, the euro has been looking pretty good so far into the meeting today and tomorrow possibly. But the other thing is, I think for Ukraine and Russia and these discussions, I think energy prices matter. And you can see that energy prices have been hovering around their lows as well. So again, there's some optimism that seems to be priced into FX and oil prices. And as a result, of course, any disappointment, any secondary sanctions on China, we'll likely see a reversal there. But again, I must also add, though, for FX purposes, yes, while there might be a little bit of risk sentiment feeding into the euro and the recovery in the euro that we have seen this year, again, when we look at correlations and other drivers, I think there are other many positive things happening for the euro currency. So again, it's going to be a push and pull.
Oh, clearly. I mean, I think we're getting used to that push and pull from the very beginning of this year itself. But Mahjabeen, how are you looking at the dollar index itself? Because we've seen it come off its highs and very strongly so, but it also seems to be supporting or protecting its downside. How are you looking at many of these events unfolding? And what's your own sense on where the dollar index could be headed from here?
Look, our view is for a structural weakness in the dollar, and again, that's pretty much broad consensus view. But we think it's not going to be a linear move lower. The magnitude of the shift we have seen earlier part of this year, I think that magnitude now going forward will be much lesser in its decline. But I think in the near term, I think the dollar is sensitive to two key things into the next week at the very least. One is obviously the US data that comes out. We also expect, again, the next CPI, the next jobs data, and how that factors into Fed cut expectations for September. And the other is that it's very, very sensitive to headlines. And we have seen Treasury Secretary come out yesterday to just say that, interest rates should be significantly lower than they are, echoing a lot of what Trump has also said previously, and that's weighing on the dollar.
And where do you see the dollar index heading? If you're talking about structural weakness from here on, we're just about holding around that 98 mark. Are we going much lower? Are we going below 95? Because there have been reports suggesting that we could go down all the way to 87 in 2026 as well. Are you that bearish?
No, we think, we're looking at 95 into this year end, and then slightly lower towards about that 92 mark towards the end of next year. And again, this is for us, even at 92, for example, we are still going to be in an environment where the dollar is actually normalizing from significantly overvalued levels. And again, that relative growth outperformance that we have seen in the US is kind of narrowing versus, obviously China is now starting to look a little bit more optimistic. Europe, fiscal stimulus is coming all out. That's a long-term story. And so as a result of that, I think you're going to see that narrowing of growth differentials, which would then play out in that weaker dollar.
You talked about euro earlier, and when you look at the so-called safe haven currencies, whether it's about the Swiss franc or the Japanese yen, the carry trade that we've seen unwind quite strongly in this year, but also the high-yielding currencies like a euro or an Australian dollar, how are you looking that reaction? Because with the dollar decline initially, we saw a lot of support come in for these currencies, and now they seem to be hitting some resistance.
Yeah, look, I think euro has been kind of the primary avenue of the anti-dollar trade. And for at least the first half of, from Liberation Day up to June, July, we did see the euro swapping roles with the US, which means that euro becoming the safe haven currency, US trading like a cyclical currency, just because the market was viewing all the tariff risks as more of a US isolated growth issue rather than a rest of the world growth issue. Now, what we are now seeing as we come out of it is that even the data coming out of the US is not as negative as was initially expected. The tariffs have all been laid out at a much at a smaller extreme or lesser extreme than initially we saw on 2nd of April. And also, big thing to note is that there's no retaliation or retaliatory tariffs that would have made volatility move up and more risk off. So again, things have continued to stabilize, and maybe finally now markets will move to fundamentals based on the macro dynamics that will play out.
And Mahjabeen, a lot has been said about the BRICS and the currency that is in conversation there, whether it's in or not. But the US president clearly continues to talk about that, and some more penalty tariffs if it continues as well. How have you seen that development, if at all?
In terms of reserve currency or an alternative reserve currency, look, I think there is, again, no alternative, no better alternative than the dollar at the end of the day. So despite the fact that we are calling for a structural decline in the dollar, we still think that it will remain a dominant currency going forward. And the reason for that is, again, the next best currency you could think of here is the euro market. But again, the euro bond market is very fragmented. Italian bond yields pay you something different. German bond yields pay you something different. Nothing like the treasuries, which are more uniform. And also, again, the depth of the treasury market is so much deeper than the European bond market. So again, it'll be hard to replace the dollar from a reserve currency perspective or any other currency.
Get your point on that. Mahjabeen, also, with the dollar declining, as you said, 95 by the end of this year, 92 perhaps in the next year, what is a safer place to bet when it comes to currencies then?
Look, I think traditional currencies, as you mentioned, Swiss franc, Japanese yen, and at the margin, you could argue euro. But Japanese yen is quite interesting right now because finally they are offering positive yields and higher yields, and they're probably the only bank that's on a hiking regime at the moment. And I think that will play out going forward. We are looking at dollar yen at 138 this year, so a stronger yen ahead as Bank of Japan continues to raise rates. And again, that on top of the safe haven flow that it demands, I think should be helpful in the face of a weaker dollar.
Mahjabeen, I know cryptocurrencies is not something that everybody tracks, but the way this one has been rising, and it's called currency sometimes and commodity sometime, and the various or digital assets the other then. But we're looking at all-time highs on Bitcoin. Ethereum is not too far away from its all-time high as well. We're looking at a record market cap as where it stands. Do you see it coming mainstream? Do you see it as an asset class standing or, in some sense, growing?
Look, I think can't really comment on Bitcoin or its prices, but what I can say is that the rally that we're seeing in risk assets broadly in equity markets, as well as these other assets, are a function of liquidity. There's a huge flush of liquidity still out there in the market, and that should keep, again, risk momentum ongoing. So I think that's something to think about. On top of it, clearly the larger central banks are all in an easing cycle. Again, that's positive for liquidity. So risk on assets that benefit from a risk on momentum will continue to likely benefit.
All right, that makes sense. Mahjabeen, as always, thank you so much for joining in and looking forward to speak to you very soon yet again. That was an interesting conversation. Thank you for your time. Well, with that, we'll go for a very short break. But when we return, we will have Hansen, Head of Commodity Strategy at Saxobank, telling us on how he is looking at various global events and its impact on many commodities after this break. Welcome back, and we're joined by Hansen. He's Head of Commodity Strategy at Saxobank. Hi, thank you so much for taking your time out. I actually want to continue the crypto question that I was asking the previous guest before the breather as well. What is your sense? Do you see that as an emerging asset class at all?
The crypto?
Yes.
Yeah. Well, I think you have to accept the fact that it is rallying very strongly. It has achieved a great deal of success. I'm not going to use some of the words I probably use in private about it, but it is a market which is basically driven on pure the fact that there is tightness, and driven on the belief that someone will be prepared to pay a higher price tomorrow. That is. I think that's basically what I have to say on that. But clearly, given what we're seeing in the wider economy, especially the U.S. economy, and the worry that potentially we could end up in a situation of QE if they continue to just issue all their debt at the front end following succession of rate cuts, then obviously investors will be looking for alternative assets, and that basically means Bitcoin could easily, and some of the other coins easily, go a lot higher before we potentially run into another major correction. And the same thing goes for some of the other tangible assets, which is where I'm focusing, that obviously in the commodity space.
I will talk about gold now, and with the kind of scenario that we are working with and some of the concerns that you just highlighted, where do you see the gold prices? Because we've been consolidating for a very long time. A 25 basis point of a rate cut in September perhaps is baked into the prices already. How would you look at September and the US Fed cut in sense of interest rates and its impact on gold? How are you reading gold in light of that?
Well, I think we increasingly have to view the current chairman of the FOMC or the Federal Reserve as a lame duck, because there will be another person replacing him, and that person will be appointed by a president who's desperate for lower rates. So lower rates are coming almost no matter what the wide economy is doing, and I think that will be a key driver. But obviously, we've had several of these false starts or hopes in terms of rate cuts. So I think the market really right now is just saying show me the money or show me the cuts. And with that in mind, there is a bit of a wait and see mode in the market. We also got Jackson Hole coming up later this month, which potentially could be a trigger. But I think generally the fact that we saw this very, very strong rally in gold prices up until April when we hit a record high. And since then, the correction that you would look for after such a big move has really only been consolidation. We've been range bound, as you said, for a while, and when you manage to only to be range bound, not correct after such a big move higher, that tells me that the underlying demand has not gone away. We're seeing demand through ETFs picking up once again, both for gold but also for silver. So at the year end, I think once we take out which I think we will, the previous highs, I'll be looking at 3450 as the first sign, but obviously then 3500. If we do take that out, then obviously the market will start to talk about 4,000. And if some of the worries that we have about potentially the front loading of debt and the QE, which may be a case next year, then 5,000 could be within reach within the next 12 months.
Oh, wow. Okay, $5,000 in 12 months if we actually are looking at QE. You also said that you're very bullish on silver then, and this is a commodity that has been eyeing that $40 an ounce mark but hasn't been able to get to that. You think by the year end we will do that? And also, how do you see 2026 with silver?
Well, if you break higher in gold, then silver will do what silver does best, basically being gold on steroids. And that means that 40 level, which we almost reached last month, is once again within reach. And then, if that is taken out, then the market will automatically start to look at the record highs around $50 going back in 2011. So yeah, I know this is quite a bullish outlook, but I think just looking at the world as it is right now, it's really not a market where you don't want to be long tangible assets. We are seeing inflationary pressures moving higher. We're seeing the dollar potentially moving lower as rate cuts are starting to come in. So we're painting it. I think we are seeing a world that is supporting that belief. So that's why we hold quite a bullish outlook for these metals.
Since we are talking metals, what's your sense also on the industrial metals there? Because ferrous metals seem to have done well in this week with steel and iron ore prices back near their highs. What has not done so well really is the copper. While we are looking at positive moves on to this one, but they're too far away from the kind of all-time highs that they saw. If we are talking near recession, if we are talking decline in dollar index and gains in safe havens like precious metals, then are you kind of turning bearish into many of these industrial metals?
Well, I think we just have to look at the trillions of dollars that needs to go into data centers if we want to achieve all the AI goals that many of these major and very wealthy companies they want to achieve. That basically means that even if we may have an economic slowdown in some parts of the economy, the process will continue. And with that in mind, the copper story is still well and truly alive. What we're suffering from in the short term is really the dislocation that we saw during the tariff speculation that we saw up until recently. First, a big run-up in copper prices leading to a massive amount of copper being shipped to the US. And now with the tariffs being cancelled, there's a lot of copper stranded in the US that will potentially could find its way back into the market. And that's why the price action has gone a bit stale here. I think for now, just watch the London copper price. It has actually been behaving very well throughout the last 6 months, while the New York copper has been on a wild ride, simply because the market tried to gauge what the level of tariff would be and what impact it would have on US prices. So I think the underlying demand for copper is still there. Chinese economic data is actually proving to be fairly resilient. So that is still a major driver. So the positive outlook for copper has not been dented by these developments and the worries about a slowdown, but it has been impacted by these tariff shenanigans, which are now just creating some upheaval here in the short term.
Then what kind of levels are you looking at for copper, let's say for the next 8 to 12 months for that matter? And do you see aluminum and zinc following in some sense?
Copper probably the main focus. I think the supply situation in aluminium is still fairly okay. the supply side in copper will, I think, increasingly start to receive some attention if that demand that we expect continues to emerge, driving prices higher. So the 10,000 level is one where we stabilized for a while. We're still just stuck below that level right now. But with that in mind, if we see that pick up, then 12,000 would be a natural next level so a 20% plus increase over the next 12 months. And whether and basically based on the movements we've seen in high grade, it's difficult to really use that one as a gauge for now. So I think for now we're going to use London copper as the main benchmark, simply because it's probably telling the best story in terms of the supply and demand situation.
Clearly. Well, I've kept the best for the last, and this is really about the crude oil prices. With that meeting slated tomorrow between the US and the Russian presidents, with everybody kind of talking everything around it, how are you reading this meeting, the initial sentiments really? What are you expecting? And are the crude oil prices aligned to that?
Well, I think we've grown used to Trump now, but basically we have to just be very careful and say don't listen to what he says, but see what he does. So we'll see what happens after the meeting. The expectations has been toned down a little bit. He has obviously tried to involve the European side of things, and also Zelensky. So we'll see where it gets. But at the same time, you can also argue that Putin is not going to Alaska without giving Trump something, simply because that would be he knows how he can react. So Putin will give something, but the question is whether that is enough and whether that is palatable for the Europeans and for the Ukrainians. So I think with this in mind, the risk in the short-term risk in the oil market potentially is the upside, simply because if we see tightening sanctions, because the kind of premium, or the what do you call it, the benefit of a deal, I think, has been priced in at this point. But generally, where does it leave oil prices? Well, I think we just saw the IEA coming out yesterday predicting a record glut next year. It's obviously not what OPEC is predicting, so it highlights the difficulty in really getting a true picture about the oil market. But generally, the market is well supplied into the winter months, and with that in mind, 70 in Brent seems to me as quite a bit of a ceiling right now for oil prices.
What also is your sense on the dollar index going forward? Because everybody seems to be quite bearish onto that one. Would be interesting to get your own numbers to this.
Well, we've gone through a consolidation here in the dollar, but just like we saw, the gold price didn't really correct much lower. The dollar didn't correct much higher during this period, and that does indicate that the underlying direction still points to a weaker dollar. So if we start to see this, the rate cuts being implemented, and I think if we do get 0.25% next month, that will just be the start. Then we will see a succession of cuts, and also just the risk that the tariffs that kicked in this month will only start to be felt in the economy in the coming months. So with that in mind, I think the trajectory for the dollar points to lower prices at this point.
A weak dollar and all-time highs expected in case of gold and silver prices. Metals as well supported, with copper expected at $10,000, even $12,000 in next 12 months is something that we will have to watch out for. But clearly, as you said, it is an interesting meeting tomorrow, and very well said, all that, yes, the US president, rather the Russian president will give something, will take along something to Alaska, wouldn't go without that. So that's going to be an interesting tomorrow there. Thank you as always for joining in, and appreciate your time and making sense of what all is happening in the international markets, really. But with that, it's a wrap on this edition of Big C. Thank you for watching.